So what if you could get the upside of the stock market, but without any of the terrifying downside? That is the incredible promise behind something called a fixed indexed annuity. Today, we're going to pull back the curtain and see exactly how they work, what the catches are, and figure out if it's actually the right move for your retirement savings. You know this feeling, right? It's the classic retirement tug of war. On one hand, you know you need your money to grow just to keep up with inflation. But on the other hand, the thought of a market crash just wiping out years of hard work, well, it's terrifying. So where's the middle ground? How do you get that growth without risking the whole nest egg? Well, to try and solve this exact puzzle, the financial world came up with a special kind of product. It's called the Fixed Indexed Annuity, or FIA for short, and it's sold on this one big idea: giving you the best of both worlds, safety and growth. All right, so what is this thing, really? At its core, an FIA is an insurance contract. And that's key. It's not a direct investment in stocks. The deal is it makes two huge promises. First, your principal, the money you put in, is 100% protected from market losses. And second, you still get the chance to earn interest when a big market index, like the S&P 500, has a good year. Let's paint a picture. Imagine on one side, you've got your ultra-safe stuff, like CDs. You're not going to lose money, but you're not exactly going to get rich either, right? Then, way over on the other side, you've got the stock market itself. Unlimited growth potential, but also, unlimited risk. The FIA was designed to live right in that sweet spot in the middle of the road. So it really does sound like the perfect deal. But how on earth can an insurance company promise you market gains without any of the risk? Well, to get that, we've got to pop the hood and see how this engine really runs. Okay, this is probably the single most important thing to understand. With an FIA, your money is not actually in the stock market at all. Instead, the insurance company just uses an index, like the S&P 500, as a benchmark, like a big measuring stick, to figure out how much interest to pay you. So here's how it plays out. You start by funding the contract. Then the insurance company keeps an eye on the index you chose for a year. Now, if the index goes up, they put some interest in your account, though there are some limits, which we'll get to in a minute. And if the index goes down, well, this is the magic part. You just get 0%. You don't lose a single penny of your money. That's what they call the 0% floor. You know, a really great way to think about this whole process is with a simple baseball analogy. Just picture that every single year of your contract, you get a fresh turn at bat. So, if the market has a good year and the index goes up, bam, you get a hit. You've earned some interest. And here is the absolute best part. That gain is now locked in. It becomes part of your account value, and you can never, ever lose it in a future market downturn. It's yours to keep. But what happens if the market has a terrible year and the index plummets? Well, you strike out. That's it. You earn 0% interest for that year, but you don't lose anything. Your original money and all those gains you locked in before are totally safe. Then, next year, you're right back up at the plate for a brand new swing. Okay, so market gains with no risk of loss, it still sounds a little too good to be true, doesn't it? Well, as you'd probably expect, all that protection comes at a price. And that price comes in the form of limits on your growth. Let's talk about the fine print. The first and most common limit is something called a cap. It's exactly what it sounds like, a ceiling on how much you can earn. So let's say the S&P 500 just has a monster year and goes up 15%. If your contract has a 10% cap, well, the most you're going to get credited is 10%. Simple as that. Another way they do it is with a spread. Think of this like a little hurdle you have to clear. The insurance company just shaves a certain percentage right off the top of the index's gain. So if the index is up 8% and the spread is 2%, they take their 2, and you get credited with the 6% that's left over. And the third common tool in their toolbox is the participation rate. This one's pretty easy to understand. It just determines what percentage of the index's gain you actually get to, well, participate in. So if the market goes up 10% and your participation rate is 80%, you get credited with an 8% gain. Now, you really need to listen to this part because this is the biggest gotcha you have to be aware of. Those caps and spreads and participation rates we just went over, they are not guaranteed for the life of the contract. After the first year, the insurance company can change them. This is called renewal risk, and it's a huge deal. That really attractive 10% cap you signed up for could be dropped to 6% in year 2, which obviously has a massive impact on your earnings potential going forward. So, you've got the pros, you've got the cons, you've got the complexities. The million-dollar question is, How do you figure out if an FIA actually makes sense for your retirement plan? Let's put this into perspective. Compared to something like a MYGA, which is just an insurance company's version of a CD, the FIA offers a lot more potential for growth. But when you compare it to a variable annuity, where your money is actually in the market, the FIA has way less risk, but also a much lower potential return. It really does live in that middle ground. So who is this really built for? An FIA can be a really strong choice for someone who's near retirement or already in it, and their number one absolute top priority is protecting their principal. But they still want to earn a little bit more than what a CD can offer. They're also handy if you're looking for tax-deferred growth or if you want to eventually turn that money into a guaranteed paycheck for life. On the other side of the coin, you should probably run in the other direction if you want to capture every bit of the stock market's growth and you're comfortable with the risk that comes with it. And this is a big one. These are long-term contracts. If you need to get your hands on that money anytime soon, this is not the place for it, because the penalties for cashing out early can be severe. All right, so after all is said and done, after the caps, the spreads, the resets, what kind of return can you realistically expect? Let's be really clear here. This is not a stock market replacement. Historically, over the entire length of a contract, FIAs have usually delivered average annual returns somewhere in that 4 to 7% neighborhood. It's a tool for moderate growth with safety, not for hitting a home run. Ultimately, the whole decision really boils down to this one question. What is more important to you for your retirement? Is it pure, unshakable safety, or is it maximizing your potential for growth? If you can answer that honestly, you'll know if a hybrid product like a fixed indexed annuity has any place in your plans. There's no perfect answer, only the one that's right for you.